Trading with indicators is useless. Actually, it's worse than useless because indicators are delayed metrics that slowly destroy your ability to truly understand what the market is doing right now. In fact, I go as far as saying relying on indicators is one of the biggest reasons traders are stuck losing for years. And I'm not exaggerating. I don't say this lightly either. I say this as a trader who has been through that struggle and knows exactly what it takes to stay profitable in the long term. Now here's the problem. Most traders are taught from day one that indicators are the answer. That if they can find the right combination of moving averages, RSI, MACD, VWAP, volume, whatever it is, then suddenly the market will make sense. But if that actually worked, 90% of traders wouldn't be struggling like they are. The truth is, indicators don't actually give you clarity, they give you false comfort. They make you feel like you have confirmation, but all they're really doing is showing you what's already happened. And for most traders, that's the trap. Now, some people might say indicators aren't the problem, it's a skill issue. That most traders just aren't experienced enough to use them in the right way, and I disagree. You do not need to be a genius to succeed at trading. It's not some impossible task to take a few high quality trades each week and have a positive outcome. But there are entire industries built on convincing you that the market is super complicated, that you either need someone else to manage your money or that you need 12 indicators, 5 computer screens and a crazy market data subscription to find the magic combo that will really work out. So in this video, I'm going to show you exactly why trading indicators put you at a disadvantage from the start and what you can use instead to trade profitably over the long run and actually build consistency. So why do indicators not actually work? Now, the main reason indicators fail traders is simple. Indicators are delayed. Every indicator you use is built from one thing: price. That's it. Indicators don't predict price, they react to it. They're math formulas layered on top of what has already happened on the chart. So when you're waiting for an indicator to signal to buy or sell or what direction the market's gonna go, it's quite often too late. Think about it. When price starts ripping higher, an indicator won't catch it immediately. It needs time, it needs candles, it needs data to confirm what is happening. And by the time it confirms, the move or crazy market action is already halfway over. That's why so many traders, and myself included, felt like I was always chasing moves. You end up buying at the top because the indicator finally has turned bullish, or you short at the bottom because the indicator has finally started to say, oh yeah, you're in a really strong downtrend. And actually, the trend has already showed signals that it's stopping and going to turn around. And it's not because you don't know what you're doing, it's because indicators train you to react to what the market is doing instead of reading what the market is telling you. Now compare that to price action. Price action is raw data. It's the market speaking in real time. It's not filtered, it's not delayed, it's not gone through some crazy math formula and interpreted in some specific way. It's just buyers and sellers telling you what's happening. If buyers step in aggressively and a candlestick skyrockets, you'll see it instantly before the candlesticks even closed, which what a lot of the times indicators require. Price action is just telling you what the market is doing. That's the biggest misconception traders have. They think indicators reveal something hidden, but there's nothing hidden in indicators. They are just a summary of what price has already done. Price action is the source. And when you learn how to read the source, you stop needing confirmation. You stop needing 5 different tools to agree, getting analysis paralysis, and missing good opportunities. And you start actually understanding what's happening and why it's happening. Now, this doesn't mean all indicators are useless. There are some good indicators that help you quickly spot certain price action signals that aren't necessarily based off of a crazy math algorithm or delayed metrics. And we'll go over those in a minute. But overall, learning to just read the price action will help you avoid a lot of the traps that just relying on indicators will cause. So over time, through all of this practice with reading price action, I've realized some of the best ways to profit in the market are waiting for when it gets to extremes. Because when extremes happen, that's when the most money can be made. Because it's overextended so far in one direction that there is a lot of traders that are either trapped or getting too excited. And when a lot of the times things get emotional in the market, people get on the wrong side. And if you can be the opposite of that, there's a ton of money to be made. Now think of the market like a rubber band. If you stretch the rubber band farther and farther, it builds more and more tension, causing it to snap back to an equilibrium state. The market works exactly like this. In a healthy trend, it needs to have pullbacks to stay in more of an equilibrium. So if it has a move that doesn't have any pullbacks, it increases the chance of it being overextended, out of equilibrium, and it will likely have a pullback the farther and farther it goes in one direction. You can see this all over the chart when you look at it. And this gives a massive edge when it comes to trading because you can risk a small amount for a big potential profit. When you lose, let's say you risk $100, you lose $100. But when you win, you can make $300 or $400. Even if you have a 30% win rate, you are still making money over the long run, which is all that matters when it comes to trading. This is where you can have indicators help you. Once you understand the overall patterns, you can use something called the fair value gap indicator because it just makes it easy to identify areas of big reversal potential. Now that I've added this to the chart, you can see that it puts these red and green boxes. And so every time there's a red box, it's telling you that there is some overextension to the downside. So right here, there's a massive red box. It's saying it's overextended to the downside. And so things slow down and eventually reverse that. Same thing on the flip side, big green box. And so it says, okay, this is a huge move where the market's been overextended and it's gonna have to essentially give that whole move back up at some point. Sometimes it'll be really quickly and sometimes it'll take a little while before it eventually does that. But this is how you can use indicators to easily identify areas of opportunity where the market in the future could make a drastic move in one direction. Now, betting against a strong trend is very, very risky. It's easy to jump in too early. The classic phrase, the trend is your friend, is really true. Don't bet against the trend until it's clear that it's actually over. So over the years, I've actually created a simple checklist that helps you identify when the current trend is over, and coupling that with having the market being overextended makes it likely that it will reverse. There are also specific times of the trading day that this works the best that I'll talk about in a little bit too. And this is a strategy that I have used for years now and have taught other traders to become consistently profitable with. And so this works for struggling traders. Okay, so step one of this checklist that I've created over years, if you're using the fair value gap indicator, look for those big boxes to show you and easily identify where the market is extremely overextended in one direction. This is that simple thing of looking for those rubber band move potentials where the market is way too overextended in one direction, it's becoming unhealthy, and it's likely to snap back at that point. If you don't want to use the indicator, you can also just look at the price itself. Just looking at the trend of candlesticks being very one directional without pullbacks. A healthy trend needs pullbacks in it. But if it just goes down super fast or up super fast in one direction, it's unhealthy. Now to do this, I either like to look at a 15-minute chart or a 5-minute chart with these indicators to help easily identify where these swings in the market are that it's overextended. This helps you dramatically stay away from the noise and the choppiness in the market and knowing that so you don't lose a ton of money when the market's just gonna sit there or trend in one direction and not be good for trading. Now, step 2, you wanna see an overextended trend into an area of either resistance or support. Somewhere, I like to use a clean rule of where the market has already touched multiple times. And this is looking at a larger time frame chart than what you enter in on. I like to enter in on a 1-minute chart, and so I want to look at the bigger swings in the market and draw those levels off of them, because this is already pre-identified areas where the market's come up here already twice and failed. And so it's likely that it could come up again and fail again. Now, other key spots where the market might reverse are either the high or the low of the previous day or the open and the close. So these are other areas you're gonna wanna watch because they can cause the market to reverse. So step 3, I like to zoom in now to a 1-minute chart. You wanna look at and analyze the current trend into that resistance zone. And you want to make sure this current trend that it's in is actually broken and starting to show signs of reversing. Because otherwise, it's really easy to see the market start to slow down and think this is where it's going to reverse, but in reality, it's just having a healthy pullback before it continues higher. Again, never bet against a strong trend until it's confirmed that it's actually reversing. There are so many doom and gloom market predictions all the time saying that a massive crash is coming, and it never happens. A trend can last in one direction way longer than you think. Wait for a signal to show that it's actually reversing and has the potential to go down, and it will save you a lot of money. Now, step 4 is similar to step 3. It's confirming through the market structure that the trend is starting to reverse. I used to try and jump into the market early, hoping to catch something like a V top or a V bottom, because when you do, you'll feel like $1 million, but the losses often outweigh the wins of trying to catch these V bottoms. And trying to figure out how to do that will waste so much mental energy that it's easier to just skip that type of trade and wait for a more confirmed, consistent one. What you want to do is look at the swings the market trend is having. A downtrend is signaled by lower lows and lower highs, and an uptrend is signaled by higher highs and higher lows. Well, when it starts to shift, you will see a lower low get made and a lower high get made. This is called a break of structure. This is a massive signal that the current trend is slowing down or stopping, and a new trend is going to start. Now, just because this happens in an uptrend, that doesn't mean that all of a sudden it's gonna shift into a downtrend. It could go into a sideways trend, or it could just continue in that uptrend, but in a slightly slower version. But the idea is adding all these steps together increases the likelihood it will bounce and you can get a trade out of it, or at least go break even. Like in this case here, this is showing a consistent uptrend until it makes a lower low right here and then a lower high right here as well. And it breaks this low, making it a new low. At that point, it's showing you that it's starting a downtrend and you can capture a trade to the downside. Now, I've just made a new strategy PDF guide that you can download for free that will give you a clear picture and visuals of this entry checklist with do's and don'ts of the strategy. You can get it via this QR code or the link in the description below. And the last step to actually jump in on a trade, because this is probably one of the most important things to pull the trigger, knowing where to finally enter can be the hardest part of a trade because it can make or break your trade. Even if you have the right idea, I'm sure you've had this happen before where you enter into a trade and you get knocked out at a loss, but the chart still goes in the direction you were betting. That's probably the most frustrating thing in trading. So picking the right entry and stop loss location is extremely important. What I like to do is using the swings in the market, look for a break in the previous swing low if I'm looking for a short after it's made a confirmed lower high. So this market right here trends down, pulls back, starts to make a lower high here, and then as soon as the market breaks this previous low, I would enter in for a short right here and put my stop loss above this swing high. So essentially, I would enter in here with my stop up there, that would be my risk, and then I would put my profit target somewhere at 2 or 3x and wait for the market to trend down and hit that profit target and call it a day on that trade and move on to the next one. And once you're in the trade, you can manage it based on what you see the market potential. This is all about kind of zooming out and seeing the big picture again of what you think is possible. If you think there is a massive swing down potential, you can try and let the trade run a little bit more so you can capture a big move potential. Or if you think that it's more likely to start chopping around, you can go for 2 or 3 times your risk as a good profit target. I do both kind of depending on what the market is. If there's a lot of volatility, I'll give it a lot of more wiggle room and I'll try and move my trailing stop as the trade progresses so you're locking in some of your profits. But if it's kind of choppy and not so good, I'll just go for a fixed 2 or 3 times my risk. This is something that's a lot harder to do until you really understand price action and movement, but it's also really, really powerful for maxing out what you could get out of trades. Now, the last thing is time of day. The most volume in the market is in the first 30 to 60 minutes of the New York Stock Exchange open. So I watch for just 60 to 90 minutes a day and wait for an opening spike to look for reversals potentially, when and if it hits everything on my checklist. This allows me to get in when there is movement and it turns out to be a slow day. I can just call it and wait for the next day. Plus, sometimes if you catch that opening move and it's the start of a big trending day, you can capture a huge trend over the day. Now for this strategy, you can trade it on any market or time frame, but I focus on the S&P 500 futures and the NASDAQ futures. They are super powerful for starting and growing a small account. The trading platform I've used to do this for the past 5 years is called NinjaTrader. You can check that out in the description below or this QR code. Now, if you want an even more detailed step-by-step walkthrough with real trades of this strategy and how futures can help you level up your trading, check out this video right here. It'll go through every detail. Also, don't forget to get that guide of this strategy in the description below.